Following the delivery of the 2025 Union Budget, the Indian equity market accelerated into new territory. By early 2026, the benchmark Nifty 50 index officially crossed the 26,000 mark, driven by intense domestic and institutional inflows. But the Nifty 50 is not a perfectly balanced reflection of the broader Indian economy. This nested tree map reveals a heavy structural anchor. Financial services commands 37% of the index's weight. While this anchor masks aggressive internal rotations. The Nifty PSU Bank index broke away, surging 44% and outpacing the broader market. This creates a unique analytical problem for portfolio construction. Precise metrics used to value a trillion-rupee bank's balance sheet offer no utility when pricing nascent, high-growth tech sectors capturing institutional capital. Relying on a monolithic view of the Nifty 50 will result in mispricing risk. Generating true alpha in the 2026 Indian market requires a strictly bifurcated analytical approach. We call this the bimodal strategy. It relies on executing two distinct mental models to evaluate Indian equities based on structural maturity. Model 1 is mature capital. Established entities, like the private banking sector, must be evaluated through strict balance sheet mechanics. Here, value is derived from optimizing established assets and minimizing credit risk. Model 2 is sovereign proxy investing. Emergent high-beta sectors like space and semiconductors require an entirely different analytical lens. You must map state capital expenditure down to private supply chains because the apex revenue drivers remain unlisted. Institutional success requires running both of these models simultaneously. Crossing their underlying logic, applying tech growth multiples to a mature bank, or demanding mature dividends from a space supplier will break your valuation. We will deconstruct the banking giants first using efficiency metrics, and then build the proxy models required to accurately price India's deep tech future. The foundational baseline for Indian capital efficiency lies in the private banking sector. Here, the metrics are absolute, and management execution is entirely visible. This matrix isolates the industry's largest players. HDFC Bank operates as the quality standard. 2 decades of conservative lending resulted in a gross non-performing assets ratio of roughly 1.3%, paired with a reliable return on equity clearing 15%. That safety comes with a cost. Following a massive merger, HDFC absorbed a higher-cost loan book, resulting in short-term net interest margin compression and a slower credit expansion of 10 to 12%. Contrast that with ICICI Bank, the premier growth model. Following a turnaround, ICICI is driving aggressive credit expansion at 14 to 16%, while achieving an industry-leading net interest margin above 4.2%. ICICI achieves these margins by optimizing its low-cost deposits, its CASA ratio. Deep retail lending and a highly sticky digital payment ecosystem ensure cheaper funding costs, widening the spread on their aggressive loan book. Valuing India's private banking anchors is a pure mathematical exercise, measuring a management team's ability to balance pristine asset quality against margin-expanding credit growth. Shifting to the public sector explains the mechanics behind that massive 44% surge in the Nifty PSU Bank index. To understand it, we apply the concept of structural mean reversion to the State Bank of India. This descending chart tracks an 8-year grueling balance sheet cleanup. SBI systematically cleared out legacy wholesale lending risks, dropping bad loans from double digits in FY18 to roughly 3.5% by FY26. A clean balance sheet positioned them perfectly for a major macroeconomic tailwind. When the Reserve Bank of India initiated a rate cut cycle down to 5.25% and reduced cash reserve ratios, funding costs dropped instantly. The historic public sector rally was a mathematical repricing of risk following a decade-long institutional cleanup. We now shift entirely to the second analytical model, sovereign proxy investing. Consider India's space sector, projected to scale from $9 billion to $44 billion by 2033. The core structural challenge here is access. The apex entity driving mission timelines, technology, and capital is ISRO, a non-tradable government body. You cannot buy shares. This 3D supply chain pyramid outlines the solution. Investors must act as proxy analysts, tracking the 24,000 crore space and defense budget allocations and mapping them downward into specific listed supply chain tiers. The top tier represents large-cap anchors like Hindustan Aeronautics Limited. HAL integrates the heavy launch vehicles, offering low-risk exposure to state contracts, though its pure space upside is heavily diluted by broader defense and aviation portfolios. The second tier contains pure-play component suppliers like MTAR Technologies. They capture highly concentrated revenue building cryogenic engines. However, this tight integration makes them highly vulnerable to earnings volatility from mission launch delays. The foundational tier reveals the deep tech moats. Data Patterns, for example, holds an official ISRO technology transfer for synthetic aperture radar. This provides a massive competitive advantage, entirely bypassing years of independent R&D costs and clearing the path for commercial manufacturing. In India's space sector, a company's true value isn't derived from its trailing PE ratio. It is derived from its possession of sovereign technology transfers and export-cleared engineering. We apply the exact same sovereign proxy model to India's semiconductor ambitions, starting directly at the source, a 70 billion rupee allocation in the union budget. This CapEx flowchart traces how production-linked incentive schemes and a 39 billion rupee fabrication subsidy cascade through the industry. These state subsidies actively dictate which private companies, firms like Tata Elxsi, Dixon, and ASM, secure long-term manufacturing contracts. The proxy framework also clarifies the green hydrogen sector. This must be defined strictly as a heavy infrastructure and CapEx play. Evaluating a hydrogen firm using metrics designed for consumer software will yield useless results. The sector relies entirely on India's distinct geographical and economic advantage, leveraging hyper-cheap domestic solar and wind energy to achieve zero-carbon electrolysis at a scale necessary for heavy industry. Valuing deep tech and green energy in India requires mapping state industrial policy and CapEx waterfalls long before analyzing a traditional earnings report. Bringing the capital efficiency and sovereign proxy models together allows us to construct a holistic architecture of the 2026 equity market. This matrix plots the sectors based on their fundamental drivers. The x-axis measures structural maturity, from nascent technologies to established industries. The y-axis measures total market capitalization and index weight. In the top right, we find the banking giants, SBI, HDFC, and ICICI. These are the market's heavyweights. They are mature beta generators that provide the portfolio's compounding foundation. In the bottom left, we plot the space, semiconductor, and hydrogen pure plays. These are the asymmetric engines, nascent, low-weight alpha generators, relying entirely on state CapEx and technological modes. Tactically, investors balance ICICI's aggressive growth against HDFC's high-grade safety for the core portfolio. Simultaneously, they deploy sovereign proxy models to capture the deep tech boom, avoiding capital overexposure to unproven order books. Institutional outperformance in 2026 demands this bimodal mindset. You must read the balance sheet to survive the present, but you must read the supply chain to own the future.